And welcome to Pervasive Topics. This is the first financial accounting video for second year, and it covers topics that you should have learned already in FINAC 178, but it is more of a recap so that you can be fresh for the start of a new year. The word pervasive topics has to do with topics that can show up in exam scenarios anywhere from now on, be it your A1, your A2, is semester 1, semester 2. A pervasive topic can get asked any time. That is why it is the first chapter of second year, and that is why it's very important as well, because in an exam, a difference of 5 marks can make or break you, especially in second year. So the topics I'm going to be covering are income tax and employment benefits. And these are two very popular topics that could get asked regularly in an exam. Income tax particularly because of the calculations in it, and employment benefits simply because it's quite a nice discussion question and they can ask it nicely pretty much. So that's what I'm going to be explaining. Income tax is also quite easy to forget, and it's a nice recap to have if you don't have time before an exam and you need to revise and watch a video. So a brief recap of income tax before we go to the examples. Income tax in financial accounting is calculated in quite a few ways. It can be asked in a few ways basically. You can be asked to write journals. You can be asked to do T accounts, which isn't as likely, but you can be asked. You can be asked to make the statement of changes in equity, and in the statement of changes in equity, they most likely will ask you the retained earnings column. And then most importantly, they can ask you to make an income tax note. So I'm going to be discussing all of this. Firstly, we want the recap, right? We want to know what is the procedure in a company with regards to income tax. So the first thing a company does is a company makes 2 provisional payments each year. Those are tax payments, and the company makes them as a provision for the tax that SARS is going to send them later. So one is on the first day, the other is in the middle of the year of assessment. That is step 1. Step 2 is at the end of the year, the company will then make a tax estimate of how much it actually thinks it will owe. So basically there's a difference between provisional payments and a tax estimate. A tax estimate is calculated using your taxable income. So at the end of the year, the company or the entity makes a tax estimate by taking taxable income multiplied by your tax rate. So during the year, you're going to be doing taxation, and in taxation, your entire year is going to be dedicated to pretty much just calculating taxable income. However, in financial accounting, that will be given to you and you will not have to worry about any difficult calculation for it. So basically, they will give you a number for taxable income, and what you have to do is you have to take it and you have to times it by a tax rate to find your tax estimate. So make sure you're confident with those words and the difference between them. Then, after the current year, SARS is also busy doing tax calculations, and SARS is also doing a taxable income calculation. So they might do a calculation and they might think, okay, the entity has done it as well, but they've done it wrong, and SARS will send you the actual amount of tax you owe. So then after the current year, SARS will send you the correct estimate, or the correct tax amount that you owe. That tax amount can either be correct in the sense that you as the entity have paid the correct amount and estimated the correct amount, or it can be too little, so it can be less than what you paid, or it can be more than what you paid. So what does that mean? It means let me add some bullet points. Let me add this. It basically means that you make provisional payments, right? But SARS sends you how much you owe. Sends you what you owe. So basically your provisional payments versus SARS actual tax amount is the over and under provision. So that's basically the crux of any tax calculation. Then from there on, they can twist up how they ask the question, but the calculations that you would have to do are exactly the same. So you basically just have to know where do you recognize the keywords and what information did they actually give you. So from there you can do your journals, your T accounts and whatnot. So step 5 is just be prepared to use this in different scenarios. So we're going to discuss some of those scenarios now. Example number 1. Example number 1 is going to be focusing on the journals, and I like it because it pretty much shows this that I just discussed over here as application. So I wrote a nice example for us to cover. And that example, just moving it down so we have space. That example covers 2 years. A company with a 28th February year end is a provisional taxpayer subject to income tax at 27%. So we'll highlight 27% because that's important. Then during the year ended 28th of Feb 2001, that's important because that tells you what year we're in. The company estimated its taxable income to be 1 million, very important, so highlight that, and accordingly made 2 provisional tax payments of 135,000 each. Now, can you see all of these keywords that I just mentioned showing up? So upon submission of the income tax return, SARS assessed the company's actual taxable income at 1 million. So read this carefully. SARS assessed the taxable income. They're not saying that you owe tax of 1.1 million. They're saying that the income that you received is 1.1 million that's actually taxable basically. So you might have calculated your income differently. So I know it sounds strange, but basically some things as income qualify to be taxed and other things don't. And SARS knows better, obviously, because we as the entity aren't as professional as a tax practitioner would be. So that's why their calculation of our income that can be taxed is different. So be careful with the wording. Then we have a different year. We have during the year ended 2002, the company estimated its taxable income at 900,000 and made a provisional tax payment totaling of 243,000. SARS subsequently assessed a normal tax. Now they're not saying the taxable income. Now they're saying that it is the actual normal tax that they found of 229,500. Journalize the above mentioned transactions for both the 2001 year and the 2002 year. Where do you start? We've already started. We've started by highlighting the information we need. Can you see that it's all easily visible? Now we start by separating our years. So 2001 and 2002. Let's tackle the first paragraph first by following this logic over here, because this is the chronological order of the whole tax procedure for an entity. So we said that they made provisional payments, and the provisional payments were 135,000 each. If they make a provisional payment, it's a payment, so their bank is going down. The amount of tax they owe SARS is also going down, and that is a liability. So you will debit your liability, which is debit tax payable, and liabilities are found in the statement of financial position. And then you will credit your bank, which is also found in the statement of financial position. And what do? You do it by 135,000. So that's your first journal entry. And I'm just going to say this is the provisional tax payment number 1. Nextly, we're going to be focusing on provisional tax number 2. Exactly the same. Maybe the date will be different. So, well, obviously, yes, the date will be different. So, but the journals are the same. Provisional tax payment number 2 was done in the middle of the year. Then, what do we have? Upon submission of the income tax return, SARS assessed the company's actual taxable income to be 1.1 million. So, remember I said that taxable income times by your tax rate equals the tax that you owe. So over here, SARS assessed it to be 1.1 million. So you should have said 1,100,000 times 0.27 as our tax. So that's what we should have paid. So if we calculate that, that's 297,000 Rand. But what did we actually pay? We actually paid this, because that is our provisional payments. We actually paid 135,000 times 2 equals 297,000 minus. Okay, well, I calculated the over and under provisions, so let me just say 297,000. Actually, let me just calculate 135,000 times 2. I'm so used to already skipping steps that it feels strange breaking it down like this. So 270,000 is our total of our payments that we have made. These are our payments. But SARS said that we actually owe 297,000, but we paid 270,000. So we have an under provision of 27,000. I did, however, skip a step, which was our actual estimate. So at the end of the year, we are supposed to make an estimate of how much tax we owe. And the estimate comes from, let me write that, estimate comes from our calculation of our taxable income, also times by 0.27. So can you see how the scenario can change? You won't necessarily have to do this, but depending on what they say, you might. So at the end of the year, we estimate how much tax we owe, and the estimate comes from our calculation. And what was our calculation? So during the year, the company estimated its taxable income to be 1 million. We thought our taxable income was 1 million. 1 million times 0.27 should be 270,000, I think. Yeah, just got to do it for extra certainty. So that's 270,000. We record that because that is our tax estimate. This, so let's just say 270,000 is our estimate. We record the estimate by saying debit, they have many words for it, debit income tax expense, and that's an expense, so it's in your profit and loss account, and you would credit your tax payable, which is found in your SFP because it's a liability. So that is a journal entry that you make. So basically we have our provisional tax payment, another provisional tax payment, then at the end of the year, this is us recording our estimate. We record our tax estimate, but very importantly, we compare SARS's amount to the tax that we've paid actually, because the gap between what we've paid and what we have not paid, obviously, is what is under or over provided for, basically. So we don't worry about this when it comes to SARS. So over here, back to what I was when I skipped a step, where I was. Taxable income times 0.27 is the tax you owe. You should have said 1.1 million times 0.27, not 1 million, because we calculated our taxable income wrong. So that's why the tax should have been 297,000. And that is the correct amount. And remember, any tax from SARS is compared to our actual payments. And what did we actually pay? We actually paid 135,000 twice. And that was 270,000. So 270,000 is less than what we should have paid. So we have an under provision. And what do we do when we have an under provision? We have to say that we still owe SARS. So what we have to say is debit income tax expense. And you debit it with 27,000. And you would credit your tax payable. Credit tax payable. And tax payable is SFP, and that's 27,000. So that is what you do if there is an under provision. Had there been an over provision, for example, maybe SARS would have said, SARS said you owe 1,080 Rand of tax, but your provisional payments were actually 200,000, let's say. Had that happened, then that would be an over provision, because on our side we over provided our payment. We didn't have to pay them 20,000, so they now owe us. So basically you would debit your tax payable, because we don't have to pay that anymore, and you would credit your income tax expense. Debit your tax payable, SFP. It's basically just that journal reversed. Credit your income tax, profit and loss. And what you do it with is the gap between what you have paid and what SARS says you owe. That is that example complete, I hope. Oh, we still have 2002. Well, 2002 is the same thing. During the year ended 28th of Feb, it's a new year, the company estimated its taxable income at 900,000 and it made provisional tax payments totaling of 243,000. SARS subsequently assessed a normal tax of that. So just to say, we estimated how much tax we owed in the prior year, right? But we only receive SARS's results in the following year. So all of this was supposed to be in the 2002 year, because SARS doesn't send it and we don't do journals for something from SARS in our current year. It's always in the following year, or maybe the following years, plural. So that should have all been in 2002 already. And this was the journal, so I'm just going to say accounting for prior year over or under adjustment. Nextly, we say here that it estimated its taxable income to be 900,000. So let's just see, what were their provisional payments? 243,000. So we always start with the provisional payments. So we would debit tax payable and credit bank with 243,000. So that is us accounting for our provisional payments again for the next year. And then what do? Then we have to estimate how much we owe, and they gave us our taxable income. So we have to say 900,000 as our taxable income times 0.27, because that's the tax rate that we were told in the question. By the way, it should be 0.28. Well, it would be 0.28 if it was a more recent year. So if they don't tell you anything about the tax rate, assume it's 0.28. 243,000 is our tax estimate. So we go and we say debit income tax expense and credit tax payable with 243,000. So, nextly, what do they say? SARS subsequently assessed a normal tax of 229,500. So now we have to say normal tax. By the way, that will not fall in the 2002 year. That will now be the 2003 year. SARS said that, what did they say? I forgot now. Normal tax of 229,500. Prior year tax payments were equal to 243. So we paid too much because in the prior year we paid 243,000 when we actually should have only paid that 13,500. So what you do is you debit your tax payable because we don't owe it, and you will credit your income tax expense. Because the expense goes down, we don't actually owe as much as we thought we did. So debiting tax payable is SFP, crediting income tax expense is profit and loss, and it is 13,500. That is the example 1 done. Now we're going to move to example 2, and example 2 is an income tax note. So for our income tax note, there are only 3 lines, so I'm going to discuss how to make the note before actually reading this question. I decided to oversaturate the question with a lot of information that you don't need, because in exams you often don't go in there with confidence because you might be in a situation where you couldn't prepare everything in time. And when you look at something like this, it will instantly give you a lot of anxiety because you will think you need to use everything, when in the meantime you might not need to use all of it. You might only need 3 lines. So this is like to show you what you actually need and what you don't out of all of these situations. So how do you make an income tax note? You make an income tax note. Basically there should be 3 columns by first saying a title, obviously. So notes to the statements, financial statements, always say that. Notes to financial statements for year ended X. I'm just typing it like this because it's quicker. You might get a mark, most commonly you do. And then you have your income tax expense note. So you have income tax expense, then you have a title that says major components of income tax expense, South African normal tax, and under that you then have your calculations, and your calculations will be current tax, which I'm going to show you how to calculate. You have your current year, well, that's what I'm going to show you how to calculate, and your prior year, over or under provision. The formatting is not ideal. So that is your over and under provision. And lastly, what you want from this note is you want your tax expense for the current year. So that's what you say there. A nice free mark that you could get is by specifying what tax rate you use. So you can say the applicable tax rate is 28% on companies, and it's the South African income tax rate. So that could get you 1 extra mark just by specifying what they tell you, basically. So we have our income tax expense note. This is just a title. That is just a title. That is also just a title. These are what we're calculating. So that's what we're trying to get to. So let me just delete that because we don't need it. I just want to say before we do this that this is a very useful table because you don't always start from top and then go to the bottom. You might have a prior year over or under recovery, and then they might ask you to find your current year taxable income. Or they might give you the prior year and the current year, then you just have to find the tax expense. But often it's like solving for the missing figure, basically. So you can reverse things. So if you understand the procedure of this, then in a question you can remake this, even if they don't need the income tax expense note. This calculation can get you missing figures if you do need it. So let's get started with this example. We have our income tax expense note and we now know what amounts we need to calculate. So let's go and read the question. What does the question say? It says a company recently received their annual tax return from SARS. The return states that there was an under provision of 40,000. So let me highlight that in the 2014 year and an over provision of 22,000 in the 2015 year. See the information in the table below. So I like to start with the under and over provisions just because it's the first thing that was mentioned in this question specifically. And this is where your theory and your understanding of the concepts is important. Because in this note, can you see that in 2015, we have a line for a prior year over or under provision. So the amount that goes here isn't actually from the 2015 year, it's from the 2014 year, because this is all about what happened in the year before it. So I'm going to take it very slowly and break it down pretty much. Also, I noticed that when I'm tapping on this keyboard, it's very loud. So I apologize if that sound is irritating, but my MacBook doesn't really have a nice keyboard. It's quite an old one and is loud. So I'll just try to tap quietly. Anyways, back to the point. We have an under and over provision. So under provision in the 2014 year, what does that mean? The 2014 year is 2013 to 2014, right? And we had an amount for the 2015 year, which is 2014 to 2015. So let's see. It says the return said that there was an under provision of 40,000 in 2014. So in this year, we paid too little tax, but we only account for it over here. So that's why in our 2015 year, we have a 40,000 under provision from the prior year. So just to repeat that, it says the return says that there was an under provision of 40,000 in the 2014 year. We only account for it in the following year. So we put our 40,000 over here. Now we also need to know, is it positive or is it negative? And to know that, you just need to think about it logically pretty much. If the whole point of this table is to calculate how much tax you owe, then your whole focus is an expense at the end of the day. Current year tax needs to be calculated, which we're going to do, but that always increases tax no matter what, because it's a tax that you estimate that you have to pay. And a prior year over or under provision can either increase or decrease the amount of tax you have to pay. Because in the prior year, if you under provided, it means you paid too little, which means it becomes your problem this year, which is why it's positive. And that's why if it was an under provision, it would be negative because it means you owe less tax in the current year. So we'll get there. The next thing you have to do is you have to calculate your current year tax by this asterisk that I wrote. So let me just make this like that. And actually, we haven't finished discussing our over provision of 22,000 in the 2015 year. Can you see that this over provision happened in the 2015 year? Is there a line where we can include that 22,000? No, because that was in our current 2015 year, and this line is for what happened in the prior year. Had there been a 2016 column, then that 22,000 would have gone there, but there is no 2016 column, so you do nothing. Now, 2013 to 2014, no information was given. And for the current year is just our tax estimate. So it will be our tax rate times by taxable income. So let's see, what is our taxable income? We have taxable income for 2014 and for 2015. So let's take 2014 first. 28% times by 250,000 will be our tax estimate. And for our 2015 year, it will also be 28%, but it will be times by our taxable income in that year, which is 235,000. So this is our calculations, not SARS's calculations. So let's just calculate that. I'll put my calculator somewhere again. Where is it? Okay. 0.28 times 250,000 is 70,000. And then we have that times by 235,000, which is 65,800. That goes straight to your table. For the 2014 year, your estimate was that you had to pay 70,000 tax. That increases your expense. For your 2015 year, it's 65,800. Now, SARS's estimates don't go anywhere here because all it's used for is to calculate what you over or under provided to add to this line. I just put this in the wrong place. Apologies. That is supposed to go here. Right. So now you can calculate your tax expense by just adding them up. So 65,800 plus 40,000 is equal to 105,800. And that is your note complete. Over here it's 0, so over here it will still be 70,000. Now, just to add a little bit more, just to re-explain this sign thing, because it can be complicated, why don't we say over here, let's say in 2014, there was an over-provision. Actually, in 2013, there was an over-provision of, what should we make it? Let's make it 20,000. That means in the following year, we make an adjustment for that. So remember, the whole point is calculating an expense. If you estimate tax, a tax is an expense. So that is already the starting point. It increases your expense. Now you need to see, in 2014, can you increase that expense or decrease it? If in 2013 you provided too much tax, you can carry it over to 2014 and offset it pretty much. So that's why you minus it, because you don't owe as much as you said you would. And that makes your amount that you owe 50,000. So let's just make this blue because I added this to the question for explanation's sake. There we go. And is that all? Let's look here. Yes, that is all. So basically, we didn't need to worry at all about our provisional payments. That was just there as extra information. We also didn't have to worry about profit before tax. All we worried about from here was our taxable income, and then we were given the prior and over under provisions, and then we just solved for the missing figure. Nextly, and for the last part of this, we're going to be discussing example 3. And example 3 is all about making the retained earnings column in your statement of changes in equity.